Thank you very much. As Barnaby was saying, this session is really looking at the most flexible fund structuring that is possible. And we've already heard about this incredible figure, this £1 trillion, not dollars, figure that Guernsey is rightfully so proud of, collectively overseeing more than £1 trillion in the island's investment sector. But we want to dig a little bit under the surface of that and understand how and why and whether we really can increase that to 2 trillion, as John has laid down the gauntlet. So, Marc, I just want to start with you. And coming back to that figure, just set the scene for us about how that figure was achieved. With what was it achieved? What sort of structures are your clients going for? What are you seeing?
Thank you. So £1 trillion, amazing achievement. Hopefully the next trillion to come soon. So we've seen our clients have used Guernsey for many, many, many years, and that's for a whole range of reasons. One of the key reasons there has already been mentioned by John. It's the amazing professionals in the jurisdiction who understand the industry, who you can go to and explain what you want to achieve from a commercial perspective, and they will get it. Whereas we've sometimes had a more difficult experience elsewhere, where there's perhaps been less history with these types of asset classes, maybe more of a computer says no kind of attitude from regulators or other service providers. No, in Guernsey, they know what they're doing. They've been doing it for a very long time, and they come with a very pragmatic focus, which is really important. Second key point, I think, is speed to market for a lot of our clients. In particular, this has come to the fore in the last few years when the primary fundraising market has been a little bit more difficult. But of course, in primary fundraisings, now you've got perhaps 12 to 18 months of a fundraising period. But when you come to things like single asset deals or co-investments or other bespoke structures, sometimes those the timeframes of those will be determined by the underlying deal timetable. And you haven't got 6 to 9 months to get a structure set up. You may have 6 to 9 weeks. And Guernsey really comes to the fore there because they can be flexible, they can be quick, they can be pragmatic. So for all those reasons, it's not just for the main fund structures that we've seen Guernsey use, but it's for things like SMAs, joint ventures, continuation funds have been a big theme for us as well recently, given the market conditions.
And just an add-on to that, is that why we're hearing so much chatter about deal-to-deal?
Yes, I think so, absolutely. I think in a deal-by-deal model, so to set the scene there a little bit, we've seen some players in the market struggle to raise blind pool funds or blind pool funds as quickly as they used to do, or others in the market perhaps delaying their next blind pool fundraising until conditions among investors are more favorable. So what do they do in the meantime? Well, perhaps they might choose to do a single asset deal where they identify an investment that they want to do and then build a pool of capital from select investors around that particular investment. Now, again, when you're doing that, you haven't got months and months to get the structure set up. You need to do it quite quickly, and you need to do it in a jurisdiction where the regulation is not going to hinder you or hold you back from getting the deal done.
Yeah. A lot of talk about that fleet of foot, really interesting. Paul, can I bring you in? You're a relative newbie to Guernsey, or your organisation is. Why Guernsey?
Yeah, I suppose the first part of that is what will it take for us not to be considered the newbie? I think we've been investing in or through Guernsey for probably just over 10 years now. So it's a reasonable amount of time. Why did we go to Guernsey? Well, when we first decided that we wanted to invest in one of the Channel Islands, I'll be honest, our first choice was Jersey. And I know before we started, we were given 3 words that we shouldn't use. I'm afraid I've just broken the first one. I've dropped the J-bomb. But the fact is, we went to Jersey, and everything else that we have done in the Channel Islands subsequently has been through Guernsey. And the reasoning behind that is we had such a poor experience with the Jersey regulator. And frankly, someone told me, if you had done that deal in Guernsey, the GFSC wouldn't have caused you any of the problems that the Jersey regulator did. So we kind of gave it a go. And 10 years later, we're still setting up funds in Guernsey. We've got numerous SPVs in Guernsey, and we've done nothing else in the J Island.
Very interesting. Kate, tell us your story of Guernsey experience.
Yeah, so we've got over 200 vehicles in Guernsey, so carry, co-invest, funds, SPVs, nominees, holdcos, GPs, and some more I've probably forgotten. So that has given us plenty of opportunity to look at what really works for us. On the co-invest side, we've started setting up 4 co-invests at a time, getting bank accounts, mothballing them, and then when the co-invest opportunity comes up, they are there ready to deploy. We've sometimes got up to 20 co-invests alongside a fund, so that's really helped us with operational efficiency. We've also, in the last couple of years, used a protected cell company GP with an associated manager. So when we've got a new fund, set up a new cell, don't need to go and get a new GP regulated, and then you're ready to go, which again has kept costs down and operational efficiency really high.
And Tom, tell us from your structure, I think you've been in Guernsey a pretty long time. Any different experiences from the other panelists?
I mean, you're right. So, I mean, AnaCap's been in Guernsey from day one, and we recently launched a continuation fund, and that was probably the biggest test of our relationship with Guernsey, and it really delivered on everything that we needed to do, and I think that's really due to a number of key factors. I mean, over the time that we've been in Guernsey, we've got a great familiarity and network with the number of providers out there. We also know that the quality of those providers is very high, and they're used to doing things not just well, but I think to Marc's point, they're used to doing things quickly. And in a continuation fund transaction, to your point, there is an underlying transaction happening as well, and so you don't have the 6 to 9 months you referenced to raise a fund. You've got to do things quickly, and really the service providers in Guernsey, they get that. They work together, they get the transaction timetable, and you're not having to overly explain and try and bring everyone on a journey when they're used to operating in those sorts of environments.
And we've been hearing a lot about speed and how important that is, but what is it that means that things can get done faster in Guernsey? Is it just, I mean, you were saying there you don't need to explain perhaps in as much detail, but are there other elements that make it a bit quicker?
I mean, there's a number of elements. I think one of the fun things, I'm coming just to incorporating a limited company in Guernsey, one of the fun things which we have on the form you fill in when you're doing that is how quickly you want it done. And, I think it starts off with within 2 hours, then within 6 hours or within a day. So, I mean, those are the sorts of timeframes you're talking about, which is materially different from having to engage lawyers who then have to engage a notary, which then has linked to the opening of a bank account. And these are some of the items that you might have to go through in other jurisdictions, which mean that doing things in hours is just completely off the table.
Yeah, well, that's interesting. And Kate, are you outsourcing services from other jurisdictions to Guernsey?
Yeah, we are. So we are based and headquartered in Guernsey. We have had a handful of cases where we've had to use other jurisdictions, which I wasn't going to name, but Paul has broken the rules. So
you may as well now.
I may as well now. So we've had to put some funds in Luxembourg due to investor demand. What we've done is look at what really needs to be done in that jurisdiction, stripped everything back to just those services and delegated everything else back to our service provider network in Guernsey. And that for us is driven by where the expertise is, the operational, the excellence, and that to Tom's point, that just means we can operate a lot more quickly within the restrictions of being in Luxembourg. You've probably heard the headline figures of it costing 2 to 3 million euros less to run a fund over a fund's life in Guernsey versus Luxembourg. We've actually got two parallel structures, and I actually think the numbers will come in a lot higher than that. So in our case, it looks like it might come in sort of $8 million, and that is going onto your NAV and onto your returns, and for anyone in the room interested, onto your carry.
And that 8 million, what does that 8 million look like? What does it consist of that you're saying the difference between A and B?
So AFM costs that you need to have when you're in Luxembourg, depository potentially, higher admin costs, and I think actually the time to do anything, which is materially longer.
Yes, because obviously that time does literally cost money. So yeah, I can see that's a double whammy. Paul, whilst we are comparing and contrasting, other service providers here, bankers, notaries, accountants, we've been mentioning these lawyers. How do other jurisdictions compare to Guernsey?
I think before I answer that, if I just pick up on that, 8 million, that's obviously a lot of money, but what that doesn't pick up is the sleepless nights, the extra grey hairs, trying to deal with some of those other jurisdictions, just the general hassle factor that especially somewhere like, again, I'll use the second taboo word, Luxembourg. And the absence in some of those jurisdictions of quality legal advice, quality accountants, bankers that actually want to bank. And you look at somewhere like Luxembourg and there isn't that depth of quality or experience, despite Luxembourg still being the single largest jurisdiction for cross-border funds. Too many of the accountancy firms there don't understand private markets. The law firms, frankly, even the big names, are generally quite weak. And you have a sort of squeeze between the banks and the regulator where, for a regulated fund in Luxembourg, you have to have an account with a bricks and mortar Luxembourg bank. But the bricks and mortar Luxembourg banks are more interested in closing accounts than they are in opening them. And so you don't tend to have those same issues with, for example, Guernsey. And we've had, most of our fund structures have some sort of dual jurisdiction. I think we started off with Cayman as our primary jurisdiction. Then we went to a sort of Cayman Mauritius structure. We're an Africa-focused fund, so I think there is an expectation that if we're going to use some jurisdiction, it would probably be Mauritius. But actually, even though that's not on my taboo list, Mauritius is probably worse in terms of the availability and the quality of the service providers. But first off, we then had Cayman went on to one of the I think the OECD grey list. Then Mauritius were blacklisted as well, which is what brought us from a fund perspective over to Guernsey. And we found that it was far easier to structure, even if we had a Cayman fund, but with a Guernsey parallel to satisfy those investors that couldn't do Cayman. We had a Guernsey GP because the regulation in Guernsey allowed, it was far easier for a Guernsey GP to manage a Cayman fund or even a Mauritian fund than it would have been the other way around. So we still manage those vehicles out of the Guernsey team. And I think our preference would have always been to sort of just stick with now a Guernsey fund. We've had on our current offering to go back to Mauritius, but that's because of a single LP with some bizarre local policy requirements that I think we probably need to come to it later. Maybe there is some more PR type work that Guernsey Finance could do to address the issues that some particularly European investors might have. And I'm going to use the third taboo word now. It's making sure people that we completely dispel the notion of tax haven.
Tom, is that your experience, what Paul's been laying out there of different experiences, different jurisdictions, difficulties therein?
We haven't moved around as much as Paul has. That's quite you've hit all the big ones there. We've gone to Luxembourg where we've needed to. And where we've needed to has been LP-led, where some European LPs often are restricted from their LPs, or there is some roadblock in the way from them using any offshore fund structure, and so that's where we've had to move to Luxembourg. But I think in all those experiences where that's been the case, that it's just reinforced, I think, a number of the topics which have been covered on this panel already, that the small amounts of additional friction which just add up through the different processes and counterparties that you need to deal with, often where it's difficult to really assess what added value that they're bringing, just generates cost, whether that's immediate cost or whether it's more time, which leads to cost. And I don't think it's really talked about enough, really, in terms of comparison. You mentioned some statistics there, and it's quite frankly mind-boggling that number which you came up with. But I don't think LPs are as aware as they should be of what these cost constraints are, because it's not the manager who's typically picking up these costs, but it's the LPs. And it's really their back pockets which are being impacted. And so I think where structural restrictions are embedded in some investors, I think there needs to be a sort of peeling back the curtain there a little bit to understand exactly why those restrictions in there. Are they real? Are they really aware of what the additional costs they are requesting from their desired structure? And is it clear to them, and indeed clear to their investors as well?
Yeah, that makes sense. Marc, I want to talk about some of the innovations and changes that have either happened or are happening. I know the private investment fund regime changed last year, and there's more change to come?
Yeah, I think what's great about Guernsey is that they respond to industry trends, they look ahead, they're pragmatic, and they're not shy about looking at other jurisdictions and seeing what has worked well over there. So, for example, Luxembourg has got the special limited partnership. You can turn that into a cellular structure. Delaware now has the series limited partnership. We're seeing some of our clients in the market use those in very interesting and innovative ways. And so, Guernsey, for example, if they were to bring in a similar limited partnership with a cell or series structure, I think that could be something that's quite useful as another tool in the toolbox to help the jurisdiction stay competitive. I think there are hurdles to that, especially in the fund space. Every time you introduce a new legal entity, there are questions around how does it work? Are there any risks? Will there be pitfalls down the road? Certainly for cellular structures, the question tends to be, will that segregation of legal liability between the cells be respected in a legal claim or in insolvency situations? So if the jurisdiction can overcome those legal issues in a very clear way to give confidence to managers that these structures will work as they're intended to, and I think that they would be a very useful addition to the toolbox.
Okay, interesting. And Kate, on that sort of similar theme, are there, A, do you agree with Marc, and B, are there other things that you could see innovation coming?
Yeah, completely agree with Marc's points. I think we need to be targeting specific high growth segments. So we talked about tokenized fund structures, secondaries vehicles, continuation vehicles. I think we need to be using and capitalising what we've got on the ground. So case studies, you're welcome to use my number, showing the speed, the cost, the execution advantages versus our peers. We need to be out there. We need to be highlighting these costs that investors are bearing of using other jurisdictions where they're saying, no, I definitely need a European fund. But do you? But it's going to cost this much. Do you really? We need to be using all of the knowledge that people in Guernsey have got and getting them out, giving this message. And I think we need to be getting new managers into Guernsey. So the manager relocation incentives, such as those offered by the Funds Foundry.
Okay, and Kate, if I can stick with you also, just picking up on what Paul said a moment ago, I think what Paul was implying is that perhaps Guernsey can sometimes be a bit backward in coming forward about itself, promoting itself and banging its own drum. Is that something you recognise?
Yeah, I think we're very British about our achievements. So we all in the room know this 1 trillion number, but are we out there shouting about it? And I think most people in the room who have experience of working with Guernsey and with Luxembourg will say Luxembourg is a nightmare. And so while we've got to be diplomatic, of course, about this, that message needs to be out there. I mean, it's so much better operating with Guernsey, with the service providers, everybody, and it's also so much cheaper. So why aren't we getting that message out there?
Tom, why do you think the message doesn't get out? Or first of all, do you agree that message isn't clear enough? And if you do agree, why do you think that is?
I don't think the message is clear enough. I think the overriding message is that Guernsey is a nice place to do business, and that people prefer it. But really, it's a numbers game. The numbers and the costs need to be highlighted far, far higher. I mean, yes, it is a nicer place to do business, but then when you overlay that with actually what the cost savings are, the efficiencies that you're bringing by using that jurisdiction versus others, and the most importantly, the impact on underlying investors' returns that it could have. I mean, that really is the key differentiator, and I think that's the thing which needs to be focused on.
And finally, I was just thinking about some of the points that John was making, about taking advantage of the fact that English common law, a stable environment, and calm and reliable and pragmatic. And then it got me thinking yes, of course, Guernsey has all those things. The British government currently does not have any of those things. It is far from reliable or stable. Does that have an impact, what's going on in Westminster, to how people view business in Guernsey? Paul?
I'm not actually sure that does.
Good.
But I think there is the potential, though, that it is still seen as part of the British family. And to many investors, that is clearly a positive. But to some investors, and I'm thinking in particular some of the European institutions, that is very much seen as a negative. And I think because we are in multiple jurisdictions, two of which are sort of part of the British family, we have seen, to quote the words of Boris Johnson, what appear to be sort of punishment beatings for the non-UK jurisdictions, but those that are otherwise part of the British family. And I think people might deny that is the case, but it's almost the only explanation for some of the slightly strange behaviour that we've seen. For example, where one investor that we were trying to bring into a Guernsey fund started off insisting that no, it had to be Luxembourg. But when we said, okay, fine, we don't want you in the fund if you want us to have another Luxembourg vehicle, suddenly actually Mauritius was okay. Now, you can't tell me from a governance or even some tax perspective, that Mauritius, that has been on various sort of naughty steps, is any better than Guernsey. And so you start to think, well, why are they against Guernsey when they're okay with Mauritius? And you know, that's where the sort of the post-Brexit political side of things perhaps comes into play.
Do you think that it is, I mean, from where I'm standing, I can't see why anybody would choose Mauritius over Guernsey. And so are you saying that the reason was Brexit, or do you think it's something else, and that maybe that weeding out system is no bad thing?
We don't know why, but I think it's sort of speculation that it is sort of Brexit related. And as I said, that's sort of, it's a way of punishing the UK family. That they couldn't get away with otherwise, but for for that sort of, having that sort of policy allows them to make what really on the face of it are strange. There is otherwise no logic to that particular decision.
Yes, I think that's certainly illogical is one word. I'm going to wrap up this panel unless our panelists have any more sort of Jerry Springer type final thoughts that they would like to leave us with, because I'm aware that we're running a little bit late and I don't want to get too late into the coffee break. So I'm going to bang my gavel and say going, gone, unless that's fantastic. We've covered a lot of ground. Please, can you show them your appreciation as they leave the stage?